Welcome to Tax Notes Talk, a podcast from Tax Notes, the leading source of tax news, information, and analysis.
Welcome to the podcast. I'm David Stewart, Editor-in-Chief of Tax Notes Today International. This week, Campty Corn. 2 years ago, the Inflation Reduction Act included the corporate alternative minimum tax as a revenue raiser. Recently, the IRS has released proposed regs to give further guidance on this new tax. Today we'll be taking a look at what's in this latest update. Here to talk more about this is Tax Notes legal reporter Chandra Wallace. Chandra, welcome back to the podcast.
Thanks, Dave. Glad to be here.
Now, could you remind listeners about the basics of the corporate AMT?
Of course. This tax was enacted in August 2022, and at first glance seemed relatively simple. The largest corporations and corporate groups, those averaging over $1 billion in financial statement income over 3 years, must pay a 15% minimum tax on that income. But tax pros pointed out pretty quickly, though, that there are a host of tricky questions embedded in that simple statement. The corporate AMT takes concepts from financial accounting and from tax, two completely different systems that each have their own set of rules. Lawyers and accountants that specialize in one system often aren't very familiar with the other, so writing rules for this new hybrid system is a heavy lift for the government, and figuring out how to comply with them is likely to be a heavy lift for taxpayers too.
So tell us about the new regs.
Sure. On September 12th, Treasury and the IRS published proposed regulations. That reg package is more than 600 pages long and very complex. It incorporates some interim guidance the government provided for taxpayers over the last 2 years, and it adds new rules on a bunch of topics they hadn't addressed yet.
I understand you recently discussed this with someone. Who did you talk to?
I talked with Monisha, Santamaria, and Nick Tricarichi of KPMG. Monisha comes from the tax side and Nick from the financial accounting side, and they've been working together to parse the proposed regs and advise clients about them.
All right, let's go to that interview.
Welcome to the podcast, Monisha and Nick.
Yeah, thanks for having me.
Thanks for having me as well.
The IRS and Treasury have been working on this reg package for the corporate AMT for a little over 2 years with some interim guidance along the way. Monisha, what were you looking to see addressed in these proposed regs?
So Treasury delivered guidance that was much anticipated. And while many questions were answered, the 604-page regulation package results in more questions than answers. And engaging with the KPMG proposed regulations is like peeling an onion. So I expect more issues to come to light as taxpayers and tax advisors read and reread the proposed regulations. And even more questions will come to light as taxpayers apply those regulations to facts and transactions. But let's start with what Treasury actually delivered. They delivered guidance in some areas that were previously unaddressed, notably some of the questions in the partnership space. For example, Treasury for the first time addressed the distributive share partnership AFC rule, and that rule applies when determining a taxpayer who's in scope's liability adjusted financial statement income, and thus how much they could pay under the KPMG. The guidance also extended the scope safe harbor so corporations can use easier, but not easy, method to determine whether they're in scope or out of scope for years beginning in 24 and beyond. And the guidance also addressed certain mark-to-market issues. And I think what's even more important is Treasury delivered on prior hints to deliver a complex regime. In fact, they exceeded all expectations in terms of the complexity of the regime. So the KPMG regime at a high level combines tax and financial statement concepts. So some of the complexity in the proposed regulations is necessary because of that statutory feature or bug, depending on how you think about it. So some of the complexity comes from the importation of GAAP principles into the tax world, and some of it has to do with the way tax principles remain in KPMG. So there's no getting around the need to understand both the book rules and the tax rules. There's no getting around to understand how the regular tax rules have been morphed for KPMG purposes and how book rules have been morphed for KPMG purposes. However, some of the complexity is, in my opinion, completely unnecessary. Treasury in certain instances seems to have decided on creating an exceedingly complex random number generator For example, there are acceleration rules in the partnership context that just seem really, really hard and unnecessarily complex. And I don't think that example is one that was envisioned by Congress. Some of the complexity results in immediate to-dos. Where taxpayers find complexity that appears unnecessary, they should speak up. Treasury is asking for comments. There are over 40 specific requests for comments in the package, as well as a general request. Those comments are due on December 12th, and it's vitally important taxpayers submit comments if they want a workable regime.
Are you finding that a lot of clients are looking to submit comments?
I think some taxpayers and some of our clients are planning to submit comments. However, I think more taxpayers need to be engaged in the comment process, since some of the universals seem so obvious when you read the regulation package. I think taxpayers are often hoping other taxpayers will submit comments, and that seems like a dangerous assumption to make. So my public service announcement is that all impacted taxpayers should submit comments. And since many taxpayers who are impacted are not in scope, taxpayers who are not in scope should also consider submitting comments.
Speaking of impacted taxpayers, I noticed that over the last few weeks, as different tax advisors have been talking about working through these 600 pages of regs, one thing that people keep coming back to is that when this tax was enacted, we were talking about 100, 150 large companies were going to have to deal with it. Every tax advisor I've talked to has said that among their client base, there are a lot of companies that are having to deal with this tax, whether or not they're going to be liable to pay it or in scope. They're having to deal with issues related to this tax, even though they didn't initially think that they would be in scope.
That is definitely a fair reaction. There are more than 150 taxpayers in scope and paying a liability, if I had to guess. Furthermore, taxpayers who need to prove a negative, either that they're out of scope or they don't have a liability, have an enormous lift to prove that negative. And this is even true when a corporation qualifies for the safe harbor. For example, the requirement to determine whether a corporation is part of a foreign parented multinational group, or FPMG, is really, really, really hard under the proposed regulations. It requires several hypothetical analyses, and some of these analyses require an understanding of what the financial accounting rules could do. For example, they require an understanding of who is permitted to be line by line consolidated. So I'm going to turn it to Nick to discuss that specific issue.
Yeah, Monisha, I think this has come up in two contexts. In some cases, there might be a entity within the structure that doesn't prepare consolidated financial statements because they're not required to. And now for KMT purposes, that financial statement will need to be prepared and identified, which comes with a lot of complexity because the accounting rules around whether or not to consolidate another entity are extremely complicated. And then on top of that, as you mentioned, Monisha, there are certain, I'll say, scope exceptions to the line-by-line consolidation, the most notable of which is investment companies. And so it's not really clear, at least from my read of the proposed regs, how that type of dynamic is contemplated when a company is not required under GAAP to perform a line-by-line consolidation. Are they still going to have to do that for KMT? I think that's one of the open questions that we have.
And that's so big for so many companies because it attaches to every single 1120 filer who has to figure out if they're in scope or not, especially if they have a foreign corporation or foreign operations in the structure. I would also like to note that the KMT regime is hard on non-corporate entities. It's really, really hard on partnerships. Partnership tax and how partnerships and partners engage with the tax code is a topic I care about. And the C in KMT is corporate, and the KMT is a corporate regime. So it's not really obvious to an observer that partnerships need to pay attention. But the preamble to the proposed regulations notes that 25,000 small partnerships are impacted by the KMT in terms of reporting, and the number of partnerships, small, medium, and large, that are impacted would be much larger. One could guess this wasn't really a result that Congress envisioned.
Once the corporate AMT rules are finalized, Is calculating scope determination something like a process that taxpayers are going to be able to automate, create some sort of process for? Is this going to be something they have to model through, work through separately every year?
I think part of the KPMG scope determination processes can be automated, but it can't be made all automatic. Many of the analyses and questions will require detailed analyses under the tax rules and under the GAAP rules. And Nick just explained to us how the rules regarding whether something can be line by line consolidated require a lot of judgment under the financial statement rules. And I think he can explain how much time that would take a financial statement expert.
Yeah. If you want me to explain that, we're going to need a lot longer than the time allocated to this podcast. As I mentioned earlier, the rules around consolidation, what Monisha keeps referring to as line by line consolidation, is some of the most complicated areas within all of the, US GAAP accounting rules. I mean, in short, there's two primary models that you would look to. One is called the voting interest model, and one is called the variable interest model. And figuring out which model you're in is its own kind of Herculean task in certain, structures, especially when you get into more complicated multi-tier, organizations, which obviously are going to be common for the types of companies that are in scope of the KPMG. And then the model, voting interest versus variable interest operate very differently. And the variable interest model in particular is extremely complicated and detailed and requires a lot of judgment, not just around, explicit financial interests, but implicit financial interests, relationships with related parties, and the like. And what you're really trying to evaluate at the end of the day under GAAP is whether you have, significant economics in the entity and whether you have the power to basically direct the activities of that entity, at least the ones that are most important to its bottom line.
We invite you to join us Wednesday, November 20th, for a special in-person edition of our Taxing Issues webinar series, live in Washington, D.C. At this event, you'll hear firsthand from tax analyst Chief Economist Marty Sullivan and other top experts in the field about the future of tax policy following the results of the 2024 election. Moderated by tax analyst CEO Kara Griffith, this panel promises insights you won't find anywhere else. By attending in person, you'll also have the unique opportunity to engage directly with thought leaders and network with professionals across the industry in real time. Mark your calendar to secure your spot. This is an event you won't want to miss. The event is free, but registration is required. Check out our link in the show notes for more details.
Nick, you started at KPMG just after this tax was enacted. Were you immediately inundated with questions on financial accounting from your tax colleagues?
I'll tell you, the first time I got involved with the KPMG was, just how do we account for this, right? I spend my time on the book side of the world, the accounting, the financial statements. And so we're always getting questions around the accounting rules related to income taxes, not the income tax rules and regulations themselves. So the first question was, hey, how do we account for KPMG and the financials? And that was a very easy question. I mean, the accounting standards say this would be, an alternative minimum tax, as the name implies, and therefore you basically would just account for it as it's incurred. Meaning, a company wouldn't have to go in and remeasure its regular deferred tax assets as a result of the new regime. And then because when you pay a KPMG, you get a carry forward, which you can use to offset taxes in the future, basically just results in a balance sheet gross up, absent some valuation allowance consideration. So that's how I got started. And it was a good start because, like I said, it was very easy. And then I met Monisha, and it went the other direction, I would say, because, Monisha was very into the regs themselves and what the statute said. And there are a lot of different places within those that refer to US GAAP accounting principles. And so naturally, I had to understand what the regs said and when they were referring to GAAP for something. And that is an extremely difficult task, for someone who's not familiar with the tax world. And likewise, to then have to translate into GAAP and talk to Monisha about US GAAP, who probably learned more about it than she ever cared to. It's just very difficult when those two worlds collide. And, in the proposed regs in particular, I think there's a lot of different areas where they refer to accounting principles that is just really going to result in a ton of complexity for people like myself who are familiar with the financial statements and are responsible for preparing the books and records. And in some cases, it's just going to produce a counterintuitive result that I'm not sure Treasury was really intending to produce, which I'm sure we'll get into a little bit later. And then lastly, I would say the other area we've got involved in, this is similar to Pillar 2 in this regard, is, we have clients out there that are trying to operationalize these rules and figure out how they're impacted and how to model it. And you really need to understand tax and accounting rules in order to do that. And so there's been a lot of messaging from us at KPMG, just that this is not a tax only thing. You have to reach across the proverbial aisle, so to speak, between accounting and tax and work together to get this done. And so Monisha and I have been, working together quite a bit to try to develop some materials that would help those two groups talk to one another and figure out how to work together to, ultimately get this done for year end.
Yeah, it sounds like that process where you and Monisha are working together and bringing, each of you bringing your specific expertise together to figure out this hybrid system. It sounds like that same thing is happening in all of the different corporate offices.
What we've told people is just a really quick way to kind of visualize this. Like if we think about pre-CAMT, pre-Pillar 2, we have two sets of books and records. There's the sets of books and records that are maintained for the financial statements, and then the set that's maintained for the tax return. CAMT is going to create a third set of books. It's a hybrid between the two worlds. And that in and of itself is going to create a lot of work for companies to prepare those for the first time. And Pillar 2 is the same way. We describe Pillar 2 as a third set of books, but I guess in this case, it'd be a fourth set of books. And so just doubling, the number of books and records that you're maintaining right away, that tells you that this is going to be a lot of work.
And I've heard people talk about maybe a fifth set of books where you're tracking basis over time.
I don't know if we want to get into that, but that is in my opinion, an extremely thorny topic. And I'm not quite sure how that fifth set would be prepared, to be honest.
And I think it's noteworthy you're not just tracking asset basis, or there's not just an instruction to track CAMT asset basis. You also have to track things like CAMT basis in the stock of a corporation, like CAMT retained earnings, CAMT basis in member stock, which attaches in the tax consolidated group context, CAMT basis in a partnership investment, and then the amount of costs subject to tax capitalization method changes. So all these new CAMT attributes created by the CAMT proposed regs, as well as the CAMT attributes created by the statute itself, like CAMT NOLs and CAMT foreign tax credits. And just creating those books and having the financial accounting folks talk to the tax folks and everybody coming together in a room is just going to be a lot of time. So people might make new friends, like Nick and I did, but it also is an enormous compliance burden and time cost and money cost for corporations.
Yeah, and if you think about it, it's not just explaining how accounting works to a tax person or vice versa. The level of granularity that you need to get into in some of these situations is mind-boggling. So, it's not just these two groups getting in the room for one time to educate one another. It's like shoulder to shoulder working through some very nuanced and detailed calculations that's going to require a lot of specific information that maybe hasn't had to be prepared before. And so figuring out who's going to be even responsible for extracting that data and if it can be extracted, from a system or if it has to be prepared manually, that in and of itself is going to take a lot of time just to get the project management under control.
So as companies are starting to implement this and starting to discover maybe how unworkable some of these rules might be, is 90 days enough time to give taxpayers to comment on 600 pages of rules?
I personally would like more time.
Agree.
It feels like people are going to have a better idea what problems with the rules might be once they've had a chance to actually put them into practice or tried.
I totally agree. I think taxpayers are going to see some of the issues within 90 days, but not most of the issues. And I think one of the things that will get missed because of a 90-day comment period, I think what will get missed is how certain provisions interact with each other, as well as how each provision interacts with taxpayer facts and with common transactions.
With respect to comments and changes that people would like to see already, are there any topics that are low-hanging fruit? For instance, in the proposed regulations for the stock buyback tax, the funding rule has drawn a lot of fire. And it's something that people have submitted a lot of comments on, and it's the one thing that seems to move the most. Is there something like that here, or is this just all so interrelatedly complicated that that's not how these comments are going to shake out?
I think that there are a number of specific provisions within the KPMG regulations that appear impossible or near impossible to comply with or present clearly unreasonable burdens on taxpayers. A number of these rules seem likely to produce surprise results. At KPMG, we have a 6-page list of these unreasonable requirements, and we could make it longer if we tried. One example is the need to bifurcate amounts into pre-2020 and post-2020 amounts. As an illustration, when retained earnings in the applicable financial statement are adjusted for certain financial accounting situations, for example, a change in financial accounting concepts or a restatement as defined in the financial accounting literature, there's a rule that requires that retained earnings be bifurcated into amounts attributable to pre-2020 periods and post-2020 periods. Nick can explain this in more detail, and I will turn it to him, but this is basically impossible from a financial accounting perspective.
Yeah, and I would say it's broader than just restatements. The accounting rules change, just like tax rules change. And so when we have a new accounting rule come out, companies have to adopt it. And there's transition rules that explain how it should be adopted and how it should be reflected in the financial statements. And, over the last couple of years, we've had 3 major accounting standards come out that are new that had to be adopted recently by companies. That's the new revenue recognition standard, the new leases standard, and the credit loss impairment standard. And, in those cases, the FASB, the body that writes the accounting rules, has expressly permitted for multiple transition options, one of which is referred to as modified retrospective and is by far the most commonly used in practice. And basically what it says is, hey, as of the date that you adopt these rules, calculate a one-time adjustment and recognize it in retained earnings. You don't have to go in and say how much relates to this year versus that year versus that year. So KPMG appears to kind of outlaw that approach and will require these companies to go back in time and basically force them to adopt under what we would call in the accounting world a full retrospective approach, where they need to literally go back and recast every single year under the new rule versus the old rule to determine how much relates to pre-2020 versus post-2020. And I mean, there's very few things that I would say are not possible, and this would certainly be one of them.
That sounds daunting.
Oh, I mean, if you only knew the amount of work these companies went through just to adopt these accounting standards on the modified approach, I mean, there's a reason why they took that approach, right? It was simpler, it was easier, less time consuming, less data intensive. To force them to go back and do it under the full approach, which one is not required by GAAP, and 2, much, much, much more complicated. Daunting is an understatement.
It's important to note that just one of the many examples in the reg package that seems unworkable from both an administratability standpoint and an auditability standpoint. My other favorite example, because I'm a partnership person by background, are the rules for partnership contributions and distributions. I just don't think those are workable, and I'm hoping that Treasury gets lots of comments on those.
Yeah, and I would say, in addition to some things that we're calling unworkable, there's, I think, a lot of others where it just could be simpler, where they could still get to the same intended outcome without creating all of this confusion and complexity. One example that comes to mind is, under KPMG, you're going to have to prepare like separate financial statements, right, for the taxpayer that are derived from a larger set of consolidated financial statements. And the proposed regs have prescribed this approach called the parent-only financial statements, which is really just only mentioned in one sentence in all of the accounting authoritative rules. And it's in a different context. It doesn't actually tell you how to prepare financial statements under a, quote, parent-only concept. And so I think forcing companies to do this is, like I said, it's going to create a lot of confusion, and I expect a lot of diversity in practice because we just don't have much authoritative rules in the accounting world. Conversely, there's another method. I mean, companies prepare separate financial statements all the time. And we are very, as accountants, familiar with how to do that under a different framework, call it separate company financials or carve out financials that leverage a lot of the existing accounting rules. And it's not clear to me why Treasury didn't just kind of go with that approach, making adjustments for certain things like non-controlling interest, which I think would have produced the same result that they're looking for in terms of a starting FSI number that's then used to calculate AFSI. That would have been much simpler and much more understandable for taxpayers on how to comply.
Do you think there have been any conversations at that level between the IRS and accounting authorities to, sort of help fix this? Or do you think they're mostly just going on their own, the IRS, and Treasury?
I don't know. I wouldn't want to speculate, but to me, it seems like if that conversation hasn't happened, it needs to happen.
So I was at the Joint Committee on Taxation when KPMG was an idea on the Hill, not when it was enacted. And I know we were having many difficulties getting any financial accounting guidance. I'm hoping Treasury was more lucky, but I agree with Nick's assessment.
Yeah, we were talking about you guys at KPMG working together, your two groups working together. We're talking about that happening in C-suites. It would be suboptimal to know that the people that are actually writing the rules weren't able to have that same kind of collaboration.
So when KPMG was initially passed, Treasury and the IRS advertised loudly for financial accounting experts, and I think they hired a few. But we have to rely not just on Nick, but on Nick's deep bench of colleagues to get to answers when thinking about KPMG. And I don't think Treasury and IRS have a deep bench. So it's really, really hard. So I do hope they're getting guidance from other executive branch agencies, but I don't think it's enough.
Yeah, that's a really good point. I mean, the accounting rules that are divided into topics, and like the way we're organized is we have, subject matter experts for each topic. And what's weird about KPMG, or maybe not weird, but what's unique about KPMG is a lot of the accounting issues that are coming up, that Monisha and her colleagues are asking me about have nothing to do with tax. It has to do with what we would call pre-tax items or concepts, right? Like fair value measurement. How do you apply the equity method of accounting? How do you determine if somebody should be consolidated? What, quote, capital transactions could give rise to a gain or loss for book purposes? Those questions span almost every area of the accounting rules. And therefore, as she's mentioned, I've had to bring in my colleagues who are experts on, the topic areas that I'm not, to be able to really take a holistic view of the rules.
Thanks very much for walking us through this. I appreciate you taking the time.
Thanks for having us today.
Yeah, thanks for having me. Happy to be here.
And now, coming attractions. Each week we highlight new and interesting commentary in our magazines. Joining me now is Acquisitions and Engagement Editor-in-Chief Paige Jones. Paige, what will you have for us?
Thanks, Dave. In Tax Notes Federal, Stephen Curtis breaks down Stryker Corporation's cost-sharing arrangement. Kate Krause explores how the Bipartisan Budget Act of 2015 may apply when a partnership terminates. In Tax Notes State, Edward Bernert discusses the personal income tax withholding burdens hybrid work has placed on employees, employers, and tax authorities. 4 Evershed Sutherland practitioners examine the application of statutory construction principles to conflicts involving allocation and apportionment statutes. In Tax Notes International, 3 PwC practitioners explain Amount B and the large effect it is likely to have on transfer pricing. Viktor Borisov examines Bulgaria's legislation implementing the OECD Pillar 2 rules. And finally, in Featured Analysis, Marie Superior examines how the due diligence process for tax credit transfers has become more standardized.
That's it for this week. You can follow me online at TaxStew, that's STEW, and be sure to follow at Tax Notes for all things tax. If you have any comments, questions, or suggestions for a future episode, you can email us at podcast@taxanalyst.org. And as always, if you like what we're doing here, please leave a rating or review wherever you download this podcast. We'll be back next week with another episode of Tax Notes Talk.
Tax Notes Talk is a production of Tax Notes. You can learn more about us by visiting www.taxnotes.com/podcast. When major media wants the straight story, they turn to Tax Notes. Thank you for listening, and join us again for another edition of Tax Notes Talk.
Want more like this? Subscribe for more tax videos. Special thanks to our executive producers Jasper Smith and Paige Jones, showrunner and audio engineer Jordan Parrish, and audio engineer Peyton Rhodes.